Tonight, global financial markets are facing a developing shift that could redefine how money flows across the world economy. What begins in Tokyo's financial system is now sending signals across bond markets, currency desks, and institutional trading floors worldwide. This is not a headline-driven shock or a short-term market reaction. Instead, it is a deeper structural development inside the world's largest interconnected debt system. Early indicators suggest that Japan's financial architecture, long considered one of the most stable pillars of global liquidity, is entering a phase of strategic adjustment. And if this transition accelerates, the consequences could extend far beyond Asia, reaching into U.S. debt markets, European credit systems, and global investment portfolios. Welcome back. You are watching the Economic Insider Hub. Tonight's report is not about speculation. It is about understanding the hidden mechanics of global capital flows and why one country's internal policy shift can ripple across the entire financial world within hours. The Japanese monetary foundation. To understand what is unfolding, we need to begin with the structure Japan has built over the past 3 decades. After the collapse of its asset bubble in the early 1990s, Japan entered a prolonged period of extremely low interest rates. This environment was not temporary, it became structural. Over time, the Bank of Japan effectively transformed the country into the world's primary source of ultra-cheap capital. This created a financial condition unlike anything seen before in modern history. Borrowing costs remained near zero for years. Domestic liquidity expanded significantly. Institutional investors were encouraged to seek returns abroad. This environment laid the foundation for what global markets now know as the yen carry trade. The global carry trade engine. The carry trade mechanism became one of the most important hidden engines of global finance. Here is how it works in simple terms. Investors borrow money in Japan at extremely low interest rates. That borrowed yen is converted into foreign currencies, often US dollars. The capital is then invested in higher-yielding assets abroad. For decades, this strategy quietly supported U.S. Treasury demand, global equity markets, European real estate growth, emerging market expansion. In effect, Japan's monetary environment became a global liquidity supplier. This system worked on one critical assumption, that Japanese interest rates would remain permanently low. But financial systems built on fixed assumptions rarely survive structural change. Japan as a global credit powerhouse. Japan is not a peripheral economy in global finance. It is one of the most important creditor nations in the world. Japanese institutions, including major pension funds and insurance companies, collectively hold trillions of dollars in overseas assets. A significant portion of these holdings includes U.S. government debt. This makes Japan one of the largest external financiers of the United States government. For decades, this relationship created a stable loop. The U.S. issued debt. Japan purchased that debt. Global liquidity remained stable. This cycle helped anchor global interest rates and supported the modern credit system. But that balance is now under pressure. The shift in Japan's domestic conditions. Recently, Japan has begun facing conditions it has not experienced in decades. Persistent inflationary pressure, rising costs in energy imports, food prices, domestic consumption, are forcing a reassessment of long-standing monetary policies. One of the most critical mechanisms under strain is yield curve control, a policy designed to cap long-term government bond yields. Maintaining such control becomes increasingly difficult when inflation rises globally and domestic price pressures intensify. As pressure builds, financial markets begin to test whether the system can hold. The global implication of rising Japanese rates. If Japan allows interest rates to rise meaningfully, the impact would not remain domestic. It would trigger a global rebalancing of capital flows. Why? Because Japanese investors would suddenly have a strong incentive to keep capital at home rather than seeking yield abroad. This would change the behavior of pension funds, insurance companies, institutional asset managers. For the first time in decades, domestic Japanese bonds could become competitive again. That shift would redirect trillions of yen back into Japan's financial system. And that is where global markets begin to feel pressure. The bond market channel effect. A large-scale repatriation of capital would require one thing: liquidation of foreign assets. Among the largest holdings: U.S. Treasury securities, European sovereign bonds, global corporate credit instruments. If these assets begin to be sold in size, global bond markets would experience rising supply pressure. And in bond markets, price and yield move in opposite directions. So increased selling would likely result in falling bond prices, rising yields, higher global borrowing costs. This is not a localized reaction. It is a systemic repricing of global credit. Impact on the United States financial system. The United States financial system is particularly sensitive to movements in long-term interest rates. If Treasury yields rise sharply due to external selling pressure, the impact would spread rapidly. Mortgage rates increase. Corporate refinancing costs rise. Consumer credit becomes more expensive. Bank bond portfolios lose value. Many financial institutions hold long-duration bonds as part of their core reserves. When yields rise, the market value of those bonds falls. This creates unrealized losses that can weaken balance sheets and reduce lending capacity. In extreme conditions, liquidity stress can spread through regional banking systems and credit markets. Historical patterns of contagion. Financial history shows that crises rarely remain isolated. The 1997 Asian financial crisis began with localized currency pressure but quickly spread across multiple economies, eventually impacting global hedge funds and major financial institutions. Similarly, the 2008 financial crisis began in the U.S. mortgage sector but evolved into a global credit collapse. The key lesson is this: modern financial systems are deeply interconnected through leverage and liquidity chains. When one major node shifts, the entire structure adjusts. Japan represents one of those critical nodes today. The global dollar structure. Another layer of complexity lies in the role of the US dollar as the world's primary reserve currency. Global trade, commodities, and financial reserves are heavily dependent on dollar liquidity. Japan, as a major exporter and creditor nation, plays a significant role in recycling dollars back into US financial markets. If Japan changes its investment behavior, it alters global dollar demand, treasury market stability, foreign exchange liquidity flows. This does not eliminate the dollar's role, but it can increase volatility within the system. Central bank response mechanisms. If financial stress emerges, central banks typically respond through liquidity operations. These may include asset purchase programs, emergency lending facilities, market stabilization tools. While these tools can stabilize markets in the short term, they also expand money supply conditions and can contribute to inflationary pressure over time. This creates a balancing challenge. Stabilize markets without destabilizing currency value. The real-world transmission effect. Financial market shifts do not remain confined to trading screens. They eventually translate into real-world economic effects such as higher mortgage payments, increased rental costs, more expensive consumer loans, rising business financing costs. These changes affect household budgets and corporate investment decisions. In other words, global bond market pressure eventually reaches everyday life. Strategic outlook and future pathways. At this stage, the global system is not collapsing, but it is adjusting under accumulated pressure. Several possible pathways exist. Gradual normalization of Japanese rates with controlled market adjustment. Volatile repricing of global bond markets with temporary liquidity stress. Central bank intervention to stabilize cross-border capital flows. Each scenario carries different implications for global growth, inflation, and asset valuations. The key uncertainty is not whether change occurs, but how smoothly it unfolds. What we are witnessing is not a single crisis point, but a structural transition in global capital architecture. Japan's monetary evolution is intersecting with global debt markets at a time of already elevated financial sensitivity. This combination creates conditions where small policy shifts can produce outsized global reactions. The coming months will therefore be defined by one central question: Can the global financial system absorb rebalancing in its largest liquidity source without triggering broader instability? That answer will shape credit conditions, investment behavior, and economic confidence worldwide. For now, markets remain watchful, institutions remain cautious, and global capital is repositioning in anticipation of change. And as always, the most important developments are often the ones unfolding quietly beneath the surface, long before they appear in mainstream headlines. You are watching the Economic Insider Hub. Stay informed, stay analytical, and we will continue tracking every major development as it unfolds across global markets.